Hello everyone, in this video I am going to give you an overview of international trade finance and how it works. At the end of this video, you will be able to understand who are all the key players in international trade and how banks are involved in facilitating seamless trade. I am Jerish and I am a CDCS and I will upload videos which are useful for your CDCS preparation. The term international trade finance carries two broad components. One is international trade, which is the exchange of goods or services across international borders, and the other one is trade finance, which is the financial aid provided by the banks and financial institutions in the field of international trade through various instruments like LC, BG, etc. First, let's see what is international trade. International trade is exchange of goods or services across international borders. When it comes to trade, let it be international or inland, the main parties are buyer and the seller who are exchanging their goods or services for money. Every trade has to go through three processes. The first one is agreement between the buyer and the seller, and the second one is simultaneous movement of goods and the documents, and the third one is movement of payment. Let us see the first process. The sales agreement concluded between the buyer and the seller is an important document. This contains the goods description, unit price of goods to be purchased, shipment date, settlement terms, and much more. And when it comes to settlement terms, normally there are four methods of settlement in an international trade. They are advance payment, open account or cash basis, documentary collection, and documentary credit. This is not an exhaustive list, right? The buyer and the seller have to choose the settlement terms based on their convenience. We have to note one thing here, that is, the buyer is able to release the goods from the port only by submitting the shipping documents. So the seller will try to safeguard himself by getting the payment before releasing the shipping documents to the buyer. The first one is advance payment. As the name indicates, here buyer is paying in advance for getting the goods. This offers least risk to the seller and high risk to the buyer. And this happens when the buyer is new to the market or the seller is not willing to ship to that particular country prior to receipt of payment because of maybe country risk. And the next one is open account, which is exactly the converse of advance payment. Here, seller ship the goods prior to the receipt of payment. This offers least risk to the buyer but high level of risk to the seller. In both of these methods, the bank is having no role other than transferring the funds on behalf of the buyer to the seller. The third one is documentary collection. Here there are four parties involved: the buyer, the seller, and their respective banks. The buyer's bank is called as collecting bank and the seller's bank is called as remitting bank. After shipping the goods, seller will hand over the documents to the remitting bank. The remitting bank forwards the documents to the collecting bank. The collecting bank will make the documents for review in its counter, and if the buyer is satisfied with the documents, the buyer will authorize the payment. Once the payment is authorized, the collecting bank will send the funds to the seller through the remitting bank and releases the documents to the buyer. This happens when the collection is on site basis. If it is on a usance basis, the documents sent by the seller will contain a bill of exchange, which need to be accepted by the buyer, and on the due date, the seller places the bill of exchange for collection and he will get the payment. The simple logic is, to release the goods from the port, the buyer needs the shipping documents. To get the shipping documents, he has to authorize the payment or he has to accept the bill of exchange drawn on him, which will give a sense of security to the seller of his payment. But this method don't give any guarantee of payment unlike documentary credits. And the international rules governing collections are the Uniform Rules for Collections, ICC publication number 522, that is URC 522. The fourth one is documentary credit. In documentary credit, buyer's bank will issue a letter of credit that contain the terms and conditions to be complied by the seller. The seller will get the payment without fail if he submit the documents evidencing the listed terms and conditions fulfilled. Unlike documentary collection, here bank gives an irrevocable undertaking to pay the seller if the documents are compliant. This makes documentary credits one of the most secure methods of settlement, right? And the international rules governing the letter of credit is UCPDC 600. I will upload a separate video on letter of credit, right? After concluding the agreement, the seller will ship the goods and simultaneously he will send the documents to the buyer, which is the second process. Here, documents move either directly to the buyer or to the buyer's bank based on the payment method selected. To move the goods, here comes the transport companies. It can be a transport by water, air, road or rail. They are the key players in the movement of goods. To mitigate the risk of financial loss due to any uncertain events, usually the goods under transport are insured. So insurance companies will also come into role. Then based on the requirement of the buyer and based on the agreement, there comes the certifying agencies, because some goods need to be certified for quality, health, quantity and other parameters to satisfy the buyer. So before shipping the goods, the seller need to get the goods certified and he has to submit the documents to the buyer along with the shipping document. Apart from this, ICC or similar organization come into picture when there is a need for certificate of origin. Now comes the third process, that is movement of money. After getting the documents, the payment will be settled based on the method of settlement. That is, either the buyer will pay to the seller directly through bank or the bank will pay the seller based on the agreed terms. If the payment is on site basis, then the buyer will pay the seller as soon as he receives the documents. If it is on a usance basis, then the buyer will pay on a future date from the day of receiving the documents or any other specified date. For example, 60 days after the bill of lading date, the buyer has to pay. This completes the full cycle of a trade, right? Now, the trade finance means the products and instruments that are used to by the banks and financial institutions to facilitate seamless trade. This makes the importer and exporter to conclude their trade easily. For example, an exporter got an export order for 1000 units of auto spares. Now, to manufacture these spares, he need money to procure raw material, to manage the labor cost and other expenses. But the buyer will be reluctant to pay in advance. So the seller will go to his bank or financial institution and ask for a loan against the export order. And based on the credibility and other parameters, the bank will provide him loan, and it is called as packing credit, which is a kind of export finance and trade finance. Some exporters will be having a working capital loan as well as TAM loan for carrying out their business. Even banks can provide financial assistance by providing a non-fund based credit like a LC or a bank guarantee. After the shipment completed, the banks will adjust the credit given with the remittance received against the export. All these are some of the products under trade finance. So simply in trade finance, banks act as an intermediary and provide financial assistance to the buyer or to the seller by using any product as we discussed above, right? Now, to regulate and promote international trade, there are various organizations work across the world. Let us see one such regulator, ICC, and their publications for regulating international trade and finance. ICC has three main activities. They are rule setting, dispute resolution, and policy advocacy. And to have a global understanding and common interpretation, ICC published the following rules. Uniform Customs and Practices for Documentary Credit, that is UCPDC 600. They are the rules governing the letter of credit, right? ICC Uniform Rules for Bank-to-Bank Reimbursement under Documentary Credit, that is URR 725. Uniform Customs and Practices for Documentary Credits for Electronic Presentation, that is EUCP version 2.0. International Standard Banking Practice for Examination of Documents under UCP 600, that is ISBP 745. These are some of the publications supplementing the UCPDC. And Uniform Rules for Collection, ICC publication number 522, that is URC 522, are rules that are governing documentary collections. Next, Incoterms 2020, ISP 98, that is International Standby Practices, that are rules governing the standby LC. And Uniform Rules for Demand Guarantees, that is URDG 758, They are the rules governing demand guarantees, right? We will discuss about more on this UCP, ISBP in our upcoming videos. If you found this video useful, please give a thumbs up and hit the subscribe button, which will motivate me to do more videos. Thanks for watching and have a great time.